Right. Today we will discuss about credit administration because it is a very important role. Like we have our credit marketing part, evaluation part, then we have to manage our portfolio. So credit administration looks after that. So we will be discussing the role of credit administration along the credit chain and the typical functions of credit administration unit. This is a detailed handout. It covers the risk and supporting units, all those things, but I have covered those part earlier, so I'm not going to do that part. I will be doing the main two topics. Right? So you have seen this slide prior to this as well. This indicates the credit process starting from the origination of a facility, origination of a customer till we collect all our money back. Right? First line indicates the business line function. Right? We originate, we do a pre-evaluation, then we negotiate, then we do the approval and all those things up to the disbursement. If you can remember, very first day I did with you credit strategy, credit policy. There I showed you a graph. There you have starting from uh, origination, you go up to the approval, then you go up to disbursement, monitoring, and follow up and the recoveries. Right? So this is the part prior to approval. So you go out, get a customer, do the original strategy, what to do with this customer, then negotiate the product, then we go and approve the facility. Then it comes to documentation and closing. That means you need to do the offer letters, mortgage bonds, personal guarantees, all those things you need to draft and you need to sign and execute the things. Then you go for the disbursement. After that, you have to maintain the portfolios because we will have different risk rated customers. We discuss about internal risk ratings, we discuss about covenants, affirmative covenants and negative covenants. So okay, why are we putting covenants? We are putting covenants because we want to maintain the risk profile of the customer, what we saw today, till the end of the period. That's why we want to put covenants, right? So it's good to have covenants, but if you don't monitor those covenants, no point putting covenants. So covenant and condition monitoring, repayment monitoring, compliance monitoring, all those things need to be done because you will have different risk profiles in your portfolio. So different risk profiles need to be tackled or managed differently. Very good customers. You may not be want to visit every month or quarter. Once a year, you just visit the customer. But if it is a low risk, high risk customer, every month, like at least a call will assist you to monitor this segment, right? Like that, you have an administration part to maintain the portfolio. Then repayments. Then if you have any issues, you can go for reschedulements. If it is working well, you go get the approval and do the other parts and continue. If they are without any reschedulement or anything, if they close, just repayment and finish it off. If they are not coming for reschedulement, you have to go for a foreclosure or legal action, right? This is the credit process. So under the credit process, from documentation to this entire part is credit administration, right? Then this is little different from some of your banks, right? Because some banks in Sri Lanka, we have everything within the branch. Your approval is within the branch, documentation within the branch, document maintenance within the branch, everything within the branch, right? But CBSL and BCBS both, what is BCBS? Basel Committee on Banking Supervision. CBSL is Central Bank of Sri Lanka, right? So both of them want segregation of duties. But they say no single transaction should be completed by people who are reporting to a single head. This is the guiding principle. No single transaction should be completed by people who are reporting to a single head. See what happens? If the branch manager is the sole authority, he can bring a bogus facility. He can approve that. He can do the documentation. He can do the disbursement. He can cover up the recoveries. So entire process is managed by one person. So there is a risk of getting a bogus or fictitious customer and getting the money out. Right? If one part is managed by branch where they go get the facility and approved, so that is only the branch. Then documentation. It has to be done by someone else. Limit setup, someone else. Independent risk. Like that, if different people, because when different people are handling a transaction, their priorities are different, right? So what it says, business unit initiates the proposal, they canvass, evaluate appraisal, and do the final approval. That is the customer touch point. So this business line reports to the business head or to the CEO. Then you have a risk line where risk aim is to look at the proposals independently and see whether this risk is acceptable to the bank. In that process, I told you we have two risk units. Firstly, CRD, credit review, and then we have LRM. CRD looks after all the facilities and say, okay, don't give this structure, give a different structure, this kind of security. All those, what they try to do is to put the credit into perspective, right? So that is prior to disbursement and basically approval. Normally, risk should not come as a joint approval, but many of the banks currently risk is joint approval. So they have different set of priorities. They are reporting to the board integrated risk management committee, which is BIRMC, right? So their priority is different from the business line. So even if a business line brings a wrong case, they will try to manage it, right? Okay, then we go to the third stage. You have the credit admin unit, right? Their responsibility is to look after the basic system and basic system, our core banking system, right? Business line can approve the facility, risk can give the guideline, then disbursement part, core banking system input parts, everything has to be done by a third party who is not reporting to business line or to the risk line. So it is an independent unit. They will look at the appraisal. Then they will say, no, these covenants are wrong. These covenants should be changed. Like that, they will give their inputs. Then they will put it to the system. They will place the proper structure in our core banking system. They will do the disbursement. Then they will require supporting documents. They will look after the money of the bank, right? Then they will check for the covenant monitoring. They will check for stock values. All those management part of the credit will be done by credit admin. That is the expectation, right? But Business line can't get rid of the responsibility. They have to support the credit admin unit to get all these administration functions happening, right? We can't say it is the credit admin's job, not our job. So takeaway here is no single transaction should be completed by people who are reporting to a single head, right? So we have business line, risk line, and the credit admin. It goes to the operations basically. The principle behind the credit admin is maintaining an appropriate credit administration, measurement, and monitoring process, because banks will have to maintain and manage their different risk profiles. I just told you, AAA customer, we have very good risk rated customer, we do some part of the administration. The weight we have to give it to the administration is low. Some customers, AA, single A, B, or low, high risk customers, right? High risk customers, you have to do more work. So different risk profiles need to be managed differently. Bankers should have a system for ongoing administration of their various credit risk bearing portfolios. So the principle behind this credit administration is maintaining an appropriate credit administration, measurement, and monitoring process. We need to have credit administration to measure, monitor the process. Right? Then, when we develop a credit administration function within a bank, we have to cover 5 areas. It should be efficient and effective. Efficiency and effectiveness of the credit administration. Monitoring documentation, contractual requirements, legal governance, collateral. Those things need to be efficiently and effectively done and monitored. Right? Here, measure and monitor. So efficiency and effectiveness is a key point when we will developing a credit administration. Accuracy and timeliness of information provided to MIS, Management Information Systems. Why accuracy and timeliness? Because credit administration, they have all the information in the bank. Portfolio information, quality information, covenant information, stock information, everything is available with them. So they are the feeder to the MIS, to the board, to the senior management. Whenever we need some information, they need to provide properly. Right? We want to see what is our exposure to China. Right? Then they are the best people because all the information are there. So they can give. If we take 3-4 months to gather all the information, there's no point having that MIS separately. Because 3 months is so long, something can happen. So if you can provide it faster, that is the best to take decisions. Then segregation of duties. No single person should handle dual things, like dual control should be there. Always 3I policy, no single person, that one. Segregation of duties within the department should happen. Then control over the back office procedures. That is very important because they are the one who handles the main banking system. If we don't have proper controls, anything can be wrong, go wrong. Right? So control over the back office function. Then compliance with risk management policies, laws and regulations of the country. So these are the 5 items to be taken care of when you're designing a credit administration function in a bank. Efficiency and accuracy, accuracy and time, efficiency and effectiveness, accuracy and timeliness of MIS, segregation of duties, control over back office functions, and compliance with risk management policies, laws, and regulations of the country. Right? These are the 5 items we have to work with. Then functions of CAU. There are large number of functions. I've listed few. These are the main functions they have to handle. Establishment and granting of limits, executing, checking, maintaining security documents, maintaining insurance registry, maintaining collateral valuation up to date, periodic changes in interest rates, pledge operations, ensure compliance and monitoring of covenants, regulatory management reporting, recovery of charges and fees. These are some of the main functions they do. What do you mean by establishing, granting of limits? They are the ones who are making the system, like business line approval facility. It is a 5-year term loan, repayable in every quarterly repayment. Right? So we need to input this approved system, approved facility to the system. Right? So it has to be properly replicated in the system. Instead of quarterly repayment, if we input it as a monthly repayment, it is a problem. So you need to make an accurate structure of the credit in the system. That is the first part. Then release loan proceeds. That's what we call disbursements. They have to look after the disbursement. Branch should not be just disbursed. You should get the supporting documents. Those things should be checked and do the disbursement. If the disbursement is staged, like you are disbursing for building construction, then what CAU should do, they should look after the proper disbursement. Like you need to get visit reports, you need to get engineer certificates, everything should be checked and do the disbursement. You can't just do a lump sum disbursement. Then when you talk about short-term revolving facilities. So revolving facilities disbursement has to happen from a central unit or separate unit. Then execution and maintenance of security documentation. CAU is the custodian of documents. Right? So they are responsible for the offer letter preparation. They have to make proper offer letter. We put different covenants. If we have put something not familiar or not usual, they are the one who needs to discuss with the legal department and the business line to get the covenant properly worded. Right? So you need to have the covenants in place properly. Then you need to do the offer letter preparation. Then registration of legal documentation. Normally, legal department does the registration for immovable property. Right? All other security documentation lodging should happen by CAU department. Then release and replacement. Central safe custody where the documents are kept has to be under these people. So we get the offer letter, we sign, we send it to CAU back. Right? Credit administration people back. Then they will look at the offer letter properly again and they will include it to the system. That is the first part. Then when all the original signed documents comes back to the central unit, they need to keep it safe. right? This is not some of you are doing at the moment, right? So don't get confused. This is what BCBS wants, Basel Committee wants. Many of our banks are doing it now into different stages, but this is what they want. Sometimes some branch bank, still the security documents are held at the branch. Whereas BCBS want the central place everything to be kept. It can be a regional office, but it should not be reporting to regional manager. Right? So it has to be reported to a separate unit. Then you collect the safe custody documents, you hold the document. Release and replacement of collateral whenever required, they have to handle. Recovery of fees and appropriation, everything has to be done by them. Maintaining of insurance register, because it is a very important part. Insurance is a very important part for a credit person, because our mortgage is our second way out. If everything goes wrong, we need to recover through the mortgage. If we have not taken insurance and some calamity happens, we will lose that part. Then second way out is out. Again, customer will be affected by two things. That is, firstly, from the calamity, now they don't have a way of recovery, because bank will come back hard and say you have to pay. Bank also does not have a way out, because customers' cash flows dried out and the securities are not in place. Still in Sri Lanka, insurance is given very low weight, right? So we have to be very careful. So we need to have all mortgage properties insured properly to the market value or the insurance value, not to the loan value. Then you need to hold the original insurance policy. All should be assigned to the bank, and proper premium has to be paid. Annual reviews has to happen. So all these things has to be done by CAU. Maintaining of insurance register, annual review and renewal of insurance policies. Whenever there is a claim, they are responsible for claiming. No claim or no objection, letter issuing has to be done by this central unit, because they are the one who are maintaining the security documents. Then in our offer letters, always there has to be a clause to say, if the customer does not renew, bank will renew and debit the customer. That indemnity has to be given to the bank through the offer letter. Then maintaining collateral valuation up to date. We need to maintain up-to-date valuations, otherwise we are not allowed to use it as the value. Right? As per central bank, for regular customers, we can have 4-year valuation, NPL 3-year valuation, if I can remember correct. Right? So this valuation thing has to be done centrally. We can't have overdue valuation. Then equity share pricing calculation for margin has to happen centrally. Currency fluctuation. When we talk about CAU, it is not only our loan business line. Treasury. You have a treasury mid office. These are the people who are doing all those things. CAU spread across the bank. Right? Carry out stock inspection. Someone independent need to do the stock inspection. Otherwise, business line will be influenced by the customers. Business line has other work to do and continue. Because of the relationships, business lines may neglect those things. So stock inspection has to be done by an independent party. Right? Then periodic changes in interest rates, AWPLR, LIBOR, AWDR, system base rate change has to happen by an independent party, that is CAU. Margins, 1%, 2%, 3% margin changes, that has happened by them. Penal rate changes, that has all system inputs should be done by them, not by the business line. Business line should not touch the core banking system. Then you need to monitor the governance. It is good to place governance, but if you don't monitor the governance, no point placing a governance. Right? We say you should provide financial statements quarterly. We should have a way of monitoring whether we got the financial or not. If we have not received, there has to be a reminder. Right? Monthly 10,000 cash build up. If it is not happening, you have to have a reminder. That monitoring has to happen centrally. Regulatory and management reporting, provide all CBSL requirements. Then management reporting to the board and the top management, new loans granted, concentration data, update documentation lapses, pending documentation, neglected documentation. All those things need to be updated by CPU, CAU, right? Trade portfolio quality, because they have the information. But whenever risk management unit want information, CAU should provide. So regulatory reporting part also has to happen. That is the fifth item under the first 5 items. Then we have the supporting units. We have discussed these things. I'm not going to take this. So these are the functions of CAU. Right? You have to remember that no transaction should be completed by people who are reporting to a single head. Credit administration function or the unit needs to look after the management of the various risk-bearing portfolios. 5 principles are there when we are designing a credit function. Right? We have to look after those 5 items. Then system related things, business line should not be allowed to handle the system. No input should be done by the business line to the core banking system. It is an independent party who will replicate the approval, do the disbursement, do the follow-ups, do the monitoring and measurements. That is the independent party, that is the CAU. So these are the main functions of CAU. So that is the story about CAU, Credit Administration Function. Right? This is different from your normal work for some of you. Any questions from this part? Any questions? Right, thank you. Then we will go to do a basic understanding of derivatives, right? Can you remember when I started my risk lecture? That was my 13th lecture. I said risk will be tackled by 4 ways: avoid, accept, reduce, and transfer. Right? Those are the 4 ways we tackle risk. And I said transfer, the easiest and the nearest example we have is insurance. We try to transfer the risk of life to a life insurance, risk of a calamity by a fire insurance or flood insurance or a burglary insurance. We try to pass. But there are other financial methods of transferring the risk. Those are called derivatives, right? Those financial methods are called derivatives. This is also a lengthy one, but I'm taking you through only the main items. I will discuss you what are the 4 derivatives and the use of it. Right? So if I am to give you a brief history about derivatives, it started in 1848 in Chicago. So they started the Chicago Board of Trade, that is mainly to buy and sell, one place to buy and sell transaction. Then because they had other products, individually they can't sell everywhere, so they got a single place to buy and sell these customers. Right? Then 1865 we started the future contracts, we get the futures. So it has to be an exchange traded one. It is an exchange, like the exchange what I can give you as an example is our stock market, stock exchange. You have shareholders, share buyers and share sellers. They are selling to the exchange, buying from the exchange. They are not individually meeting each other. When I am buying stocks, I don't know who is selling. I am buying it from the stock exchange. So the credit risk, will I get my money? When I sell my stocks, will I get my money? Will be avoided. We have a central unit who is responsible for the management of the funds. Right? So we have a central exchange came in to this process in 1865. Then 1919, Chicago Butter and Egg Board, CBOT, started dealing with these derivatives. Options, futures, all those things, mainly to deal on butter and eggs, but they had other commodities, pork bellies, euro dollars, everything. This is the famous place. First, financial derivative came to life in 1972. There onward, financial derivative market is growing rapidly. That market created the financial crisis in 2008. What is a derivative? Derivative can be defined as a financial instrument whose value depends on or derived from the value of other more basic underlying variable. If you want a definition, derivative is a financial instrument whose value depends on or derived from the value of other more basic underlying variable. As example, I want to sell chicken in the future. We say after 30 days, I have to sell my chicken. I'm afraid of prices coming down. So I will ask someone and I will negotiate a price with someone. Okay, you buy it from me 200 rupees. Now I know that if my chicken is live and if I can slaughter them after 45 days, I can sell for 200 rupees. If the prices goes down, still I have agreed the investor to buy at 200. So I have a peace of mind. Similar way, if the prices goes up, investor can reap the benefit. He can buy my chicken at 200 rupees and sell it at a higher price. So that is the derivative. Right? It is a forward contract. Look at foreign exchange forward contracts. I agree to sell foreign exchange in the future at a price. That is a derivative. Right? Underlying asset is USD. The margin is the derivative. These are very basic derivatives. Right? So a derivative can be defined as a financial instrument whose value depends on or derives from the value of other basic underlying variables or instruments. Right? So we have 4 types of derivatives: forwards, futures, options and swaps. These are the 4 basic derivatives we have. Derivative types we have. I just spoke to you about the forward. Right? Gamini is the owner of the Healthy Hen farm. He is afraid of the price fluctuation. So he wants to negotiate it and mitigate the risk. He goes to a guy and say, okay, I will sell my chicken at 20 rupees a piece after 45 days. So Gamini is afraid of price reduction. So the investor thinks, no, prices will go up. He agrees. Then Gamini does not have a fear. He has a market. He knows what is the selling price. He has fixed it. Right? If the prices remain the same, no gain, no loss to both parties. At the end of 45th day, Gamini will sell and the investor will buy. But if the prices goes up more than 200 rupees, Gamini will still get 200 rupees. Investor will be in a profit. He buys at low cost and sells at a higher price. Right? If the prices drops, Gamini will be in a better position. 150 is the market price. Now we have agreed, so you have to sell it at 200. Right? So Gamini will get more than the market price. So this is a contract. This is called forward. It is one-to-one thing. You can tailor-make it. Right? But there is a credit risk. Will this guy, though there is a contract, will he buy? Will he pay me? That risk is there. So the credit risk is there, but this can be this can be tailor-made to suit the buyer and the seller's requirement. Right? It is forward. Future is almost the same. There is an obligation to buy and obligation to sell. Gamini has an obligation to sell. Buyer, investor has an obligation to buy. Right? Future is also the same, but the difference is it is traded through a exchange. So the credit risk goes out. Gamini will sell chicken to the exchange, and the buyer, whoever, will buy chicken from the exchange. Right? We sell our stocks to the exchange and we buy from the exchange. Similarly, Gamini will sell chicken to the exchange and someone else will buy from the exchange. Then the credit risk will be avoided. Right? So this is forward and futures. Then we will go to swaps. Gamini wants to take a loan. He has taken a loan. It is a variable rate. AWPLR plus 3. 50 million loan to be repaid in 5 years, monthly basis. Interest rate is AWPLR plus 3. After Gamini gets the loan, he is afraid that rates will go up. Right? He wants to fix the interest rate now. Since he has taken a fixed rate, variable rate, he can't fix it. There's another person who has a similar interest rate, similar loan, 50 million, 5-year repayment, monthly capital repayment, and a fixed interest rate of 12%. Right? For the 5 years, rate is fixed. But he thinks rates will come down. Right? Inadvertently, I have fixed my rate. I want to go take a chance and go for short-term variable rate. Right? So what happens under swap agreements? Gamini will pay the capital as it is. Other person will pay the capital as it is. But Gamini will start paying the interest of the other person. And the other person, we say Mr. Pereira. Mr. Pereira's interest, that means for 50 million, he will pay the variable rate, Gamini. And Mr. Pereira will pay 50 million interest for 50 million at Gamini's fixed rate, variable rate. So, Mr. Pereira had the fixed rate, Gamini had the variable rate. So, they will come into agreement. We will pay the capital as it is, but you need to pay my interest and I will pay your interest. Right? So, it is an exchange of cash flows. Imagine, it is an exchange. I have a variable rate loan. You have a fixed rate loan. I want to fix. You want to get it variable. Capital is same. Repayment structure is same. So you pay the capital. I will pay my capital. When the interest portion comes in, I have to pay your interest and you have to pay my interest. Right? That is the swap of cash flows. Again, this is also done through a exchange. Right? So it is not peer-to-peer, it is through an exchange. So I can go to the exchange and see, okay, 50 million, 5-year repayment, variable rate. I will go and sell my variable rate, that cash flow to the exchange. Then from the other side, someone who needs the similar cash flow will buy that. I will buy the fixed rate prepayment, he will buy my variable. I don't know who did that because it is an exchange. I am putting it, someone will pick it up. Right? Based on that, we will pay to the exchange. Exchange will settle the other party. Right? So SUP is exchanging cash flow. So if the fixed rate, variable rate goes above the fixed rate, Gamini will be in a positive position. If the variable remains below the fixed rate, then the investor will be in a positive note. Right? This is the SUP agreement. Then we go to options. Option is also little bit similar to futures. Right? There, I'm afraid that my prices will go below 200. Forget about this example. I'll take the Gamini's example again. Right? Earlier what happened, Gamini wanted to sell to a buyer at 200 rupees. Right? So he met a buyer and he agreed to sell at 200 rupees. So it is an obligation to sell and obligation to buy. Right? Under options, what happened? Gamini is afraid prices will come down. Right? What Gamini does under option is, I will buy a protection. If the prices goes down, I will sell at 200. If the price does not go below 200, I will not sell. I have the option of selling or not selling. In order to get that option, I will pay a premium. Gamini says, okay, if chicken price goes down, you have to guarantee that you are paying me 200. But if it does not go down, I will not give you. So there is an investor other side. So in order to get that risk, investor needs a premium paid by the Gamini. Okay, you pay me 50 rupees for this option. Price එක වැඩි වුණොත් ඔයා ගෙවන්න මම ගන්නවා price එක අඩු වුණොත් මම ගන්නවා වැඩි වුණොත් ඔයා මට විකුණන්න එපා. But I am waiting till that time to execute that. So I also should be compensated. Pay a premium. Look at life insurance. What happens? Says, if you die, we will pay. If you don't die, we will not pay. For that comfort, you need to pay me a premium. That is the monthly fee. Similar to this. Here, selling and buying is only an option. Future, it was an obligation. So, in order to get this comfort, the seller has to pay a commission. That is called premium. Right? So, we have forwards, we have futures. Forward is a unstandardized, customer made contract between a seller and a buyer. Future, again an agreement between a seller and buyer, but through a exchange. So it is standardized exchange rate traded. Previous one, it was called over the counter, OTC, right? So future, then option, futures and forwards, then swaps. Under swaps, what we do, we exchange the cash flows. I pay your cash flow and you pay my cash flow. We exchange the different cash flows. Then we come to options. It is a right to execute. It is not an obligation. If you want, on the agreed day, future date, at an agreed price, you can buy yourself. This is a not obligation, it is only a right. Right? In order to get that right, we pay a premium. Right? Then this is what we have been discussing. Derivatives can be used either to risk management, because I'm afraid that prices will go down. So I'm using a derivative to manage my risk. Then speculation, that means I want to take a risk and gain more. Higher the risk, higher the return. I will bet. I think no, prices won't go down. So I'm taking a thing. Someone is afraid now prices will go down, so he is fixing the price. I'm saying no, it is not going down, so it will go up. So I'm taking that fixed price. So it is speculation. Then arbitrage. Arbitrage means we play in two different markets. Similar things in two different markets. In one market I buy, in the other market I sell. So I will buy and sell. In between, I will earn a profit. Risk management. Under the risk management, you have currency risk, interest rate risk, price or stock commodity risk. That is the market risk. Then you have the credit risk. We use derivatives to cover all these risks. Foreign currency risk is any risk arising from the currency fluctuations. In order to avoid that, we can structure a derivative. Then interest rates going up and down, it will affect the bond market. So we can have any risk arising from interest rate changes can be tackled through derivatives. Then price fluctuations, gold price, oil price, whatever, anything related to price fluctuations can be tackled through derivatives. Then the credit risk, credit default swap is one of the highest selling derivatives, where if the customer default, you have to take over the portfolio, right? So will I get my money back if the customer does not pay a comfort? That is a derivative again. Currency, we can have forward, futures and options. Interest rate, again the same thing. Price risk, trade, these are the derivatives we can use for different risk. Speculation, I told you. Arbitration, I told you. Then I want to tell you this. Long position and short position under future. When the investor goes long, that is, enter a contract by agreeing to buy and receive delivery of the underlying asset at at a set price. It means that he or she is trying to profit from the anticipated future price increase. See, you go to the treasury and say, I want to buy US dollars. After these days you can't have forward contracts. I want to buy US dollars 10,000 after 90 days. Treasury will say, okay, today's is 203. I will give you at 207. I am thinking that price will go up. So I am going to buy in the future at an agreed price. So expectation of price to go up. Then it is called long position. Short position means treasury agrees to sell at 207. At that point, treasury thinks this will come down. Exchange rate for US dollar will be lower than 207. That is the thinking from the seller's point of view. Long position and short position. Right? Then on the options, we have two things. Call option and put option. Call gives the buyer the right but not the obligation to buy. Call is to buy. Put is to sell. Right? Whenever it is an option, it is only an option, not an obligation. Whenever we talk about call option, we are talking about buying part. Right? I am the investor. I want to buy chicken at 200 rupees. In order to get that right, I am ready to pay a 50 rupees premium. I want to buy. Why? I think that prices will go up. Right? So call option is to buy. Then from the Gamini side, he thinks that prices will come down. So he wants to take a call option to sell at 200 rupees. Right? That is called sell. Put option. Call is to buy, put is to sell. Gamini wants to take the right to sell at 200 rupees. Right? For that, he goes and buy a option with a put option. Right? Options comes in two things, call option and put option. When it is from the buyer's point of view, it is a call. When it is a seller side of it, it is a put option. Right? So that's all about derivatives, the basics of derivatives. There are four types of derivative. It's a financial instrument whose value depends on more basic underlying asset. Right? Here it is the chicken. Right? Call, put, whatever, it is the chicken what we are selling. It is based on the chicken, our option prices changes. Right? Premium changes. So we have futures, forwards, swaps and options. Forward is a customized package where we agree to sell or buy in a future date at a agreed quantity and agreed price. It is an obligation to sell and obligation to buy. It is over the counter, right? OTC, over the counter, and credit risk is associated because it is peer-to-peer. Right? There is no independent third party. engage in the transaction, right? It can be 2001 chicken, or it can be 99 chicken, whatever, 99 and a half chicken, whatever you can customize. Futures are again obligation to sell and obligation to buy, but this is traded through a exchange. So this obligation is standardized, traded through exchange. Then we have swaps, where we exchange cash flows through exchange, right? Example I gave, variable rate and a fixed rate. So I want to sell my variable rate part and I want to buy a fixed rate part. So it is an exchange of cash flows. Then we go to options. Options again, future, sell or buy, but it is only an option, no obligation. If the price does not fluctuate as I thought, I don't need to sell or buy. I can just avoid it. In order to get that right of selling or buying, I will pay a premium. That is option. Then we discuss about short and long position, right? Long is when the investor thinks prices goes up. It is to buy. Short means seller thinks that prices will come down, so it is seller side. Again, call and put. Call is to buy and put is to sell, right? So that is the fundamentals of derivatives. So that ends our entire lecture series, right? If you have any questions, I am happy to address those things. We will have a revision class end of November, most probably weekdays evenings, maybe 7 to 9 or something like that. We will discuss those. I will discuss with the institute, and 2 half days of Saturday and a Sunday, right? I have shared given to the institute. Haven't they uploaded both the presentations? Shashi?
Yes, sir. They uploaded the presentation, but some content is missing. Likewise, the future course description is not there.
This is not there.
Yes, derivatives is there, but not the same presentation.
Okay, I will ask them to give you the presentation. Right?
Okay, thank you, sir.
Okay. Okay, thank you very much. So we did 15 lecture notes, and we have covered almost everything. I don't know if they have scheduled the exam dates, but they are scheduling the revision dates. Earlier we used to have only 1 day, but this time we are having 16 hours of revision. So 8 hours we will try to revise all the syllabus, and another 8 hours we will try to discuss papers as much as possible. Right? Okay, if you don't have any questions, thank you very much from my side. I will be here for 1 or 2 minutes. You can ask me questions if you want.